It is Tuesday, the 11th of August, 2020. A warm and hearty welcome to Business Redefined. This is your weekly, most comprehensive look at the world of business and economics. And tonight we are focusing on the subject of the insurance of bank deposits. 4.03 trillion shillings. That is the value of deposits in Kenya's banking sector, well, at least as of the end of June this year. Guaranteeing the safety of depositors' funds is a critical pillar in any financial system. And in Kenya, the Kenya Deposit Insurance Corporation is right at the center of safeguarding these funds. The collapse of Dubai, Imperial and Chase banks in quick succession between 2014 and 2016 brought to visibility the need for a robust deposit insurance framework which enhances confidence in a country's financial system. In the recent past, there have been significant reforms in Kenya's deposit insurance framework. First, the amount insured has been revised upwards from 100,000 shillings to 500,000 shillings effective July 1st this year. Second, and more significant, is the planned switch from a flat rate premium to a risk-based premium model effective July 1st, 2021. What do these changes mean for the safety of bank depositors' funds? What do these changes mean for the resilience and stability of the banking sector? How exactly will risk be calibrated under the risk-based premium model? And is there risk-perverse outcomes that could stem from this? Earlier today, I interviewed the Chief Executive Officer of KDIC, Ahmed Mohamud, to unpack this and a lot more. Take a listen. Thank you so much for creating time for us for this conversation. And let's just kick off by having a view around COVID-19. Of course, the concern out here within many Kenyans is that potentially there could have been Kenyans reaching out for their deposits because, of course, many have lost jobs there in a very uncertain environment. How are you seeing the trend unfolding, especially from the bank deposit side?
Thank you, Julians. Thank you, Kenyans. Indeed, it's quite interesting that despite the COVID pandemic that has been with us from late February, we are witnessing a growth in the deposits with the banks, which actually shows that our depositors still have confidence with the banks and our banking system is resilient, sound and strong despite the pandemic. Kenyans are still doing business with their banks despite what you can foresee as the pandemic has maybe affected jobs, has affected businesses. We are seeing a growth trend within the deposits in the bank. Because if you look at in February, the total deposit was about 3.6 billion. Today, as at end of June, the deposit base in the banks is about 4 billion. So you can see it's a growth. We thought now the propensity, what we call the propensity to consume will be higher. But incidentally, we are seeing savings is still also growing.
Okay.
Yeah.
And I should say that when you talk about deposits, you actually meant them in trillions, not billions.
Yes, in trillions. Thank you.
All right. And one of the key developments we have right now is this issue of a bump up in the insurance coverage provided by KDIC. Just explain that to us and why this is significant.
We got assistance from the U.S. Treasury. We really want to thank our development partners. They have really been assisting KDIC together with the World Bank and the IMF, and they did a study for us. Because our coverage has been 100,000 from 1985. But incidentally, a lot of people say, why 100,000? The 100,000 was covering 97% of the depositors. Yeah. Today, if I ask from this hall, how many people have more than 100,000 in the bank, you'll find it's only 3%. Because we are a micro country, this is a micro economy. All of us actually, whatever goes into a bank, we spend. So we are covering 97%. So it was felt, no, we need now, because 100,000 in 1985 and 100,000 today, the value, of course, you know. So they worked out some scenarios, then they settled at 500,000. Indeed, initially, the prescription was, we go to 250,000. Because if you look at our per capita income, because what they say the formula is twice your per capita. And when they were doing that study, our per capita was at $1,250. Yeah. So times 2 is $2,500. Yeah. We said, no, we thought it prudent, let us double that. And that is why the figure of 500,000 was actually settled. Although the experts were saying no, because with 500,000, our exposure also grows. Yes. Our exposure had grown from 255 billion exposure to KDIC, that in the very unlikely event of a total collapse maybe of our economy and maybe banks today close, our exposure is at 255 billion. Now with 500,000, our exposure has shot to 600 billion. Yeah. So we are expected to raise 600 billion as part of our target fund. But we have a very strong fund where we invest in government securities and with prudent investment. And number two, Julian, which I want Kenyans to understand, with 500,000 years, we are all happy. We are actually the highest in sub-Saharan Africa. But in Africa, we are second to Morocco. Morocco is the only one which is higher than us. Sub-Saharan Africa, we are the highest. But to me, the 500,000 is just what I can call it is a backup strategy. We don't want to reach there. Yeah. Because the 500,000 is only payable when an institution is put in liquidation. But with now the new mechanism and the new resolution powers, which has been vested onto us through the KDI Act, we are able to resolve bank like what we did in Chase Bank, what we are doing in Imperial Bank, so that the liquidated bank will be a very small portion, if it will be there. Yeah. Very small portion. And so that you might find 90 to 95% of the bank, we can transfer it to a strong bank and people can continue doing their business. The business of deposit insurance is not to close banks. The business of deposit insurance is to build confidence in the banking sector and to make sure that banks grow in a very healthy and sound environment. Indeed, our dreams, our objectives, our strategy, our drives is to ensure there is no bank failure in this country. And in the unlikely event of a bank failure in this country, we want to resolve it as fast as possible. We have the capacity, we have the legal powers, and we have the expertise. And that is one area that we really want to work on. We don't want the stories of the old ones where 30, 40 years we are still struggling with some old institutions. Even Chase Bank and Imperial, if you talk of Chase Bank and Imperial, we could have done better. But at that time we are undergoing some transitional challenges.
There has been the conversation that perhaps KDIC, the mandate should be widened, especially around this insurance provision, to include the savings and cooperative societies. I don't know what you think about that or how far that would go.
That is one of our dream initiatives. But first, we wanted to really anchor it through the banking industry. And the savings and cooperative societies, actually I even worked with them. They are coming up with something similar to a deposit insurance. They're calling it Deposit Guarantee Fund. So I think there are some things they're also trying to develop. Now they even have their regulatory authority. Eventually, that is the ultimate goal, is to bring all these under one roof. And that is why we have to make sure that we build a very strong deposit insurance base. And Julian, also to tell you that in Africa, we are the second to Nigeria. And indeed, today, most of the African countries who are coming up with deposit insurances, their point of call is Kenya Deposit Insurance Corporation.
And the bump up to 500,000 shillings is effective July 1st?
From 1st of July, Kenyans, in the very unlikely event, God forbid that a bank is put under liquidation, will pay you 500,000. The 500,000 will cover 99% of our depositors. Yeah. But of course, one thing we want to assure Kenyans, one thing we, as KDIC want to assure Kenyans, we are not going to reach there. That will be a last resort. I'm using the word last twice. Be a last resort. But before that, we are called a resolution authority. We are not a liquidator. A resolution authority, ours is to resolve problem banking. It's not to liquidate.
That point by Ahmed Mohamud takes us to a break. Remember, we'll be right back now, focusing on the discussion of a transition to a risk-based premium model. Stay tuned.
Pata smartphone mpya kuanzia 20 bob daily pekee ukilipa mdogo mdogo. Weka down payment ya 1000. Lipa kuanzia 20 bob daily kwa miezi 9. Piga star 544 hash kuona kama unafaulu kupata 4G Neon Ray Pro. Si hapo Safaricom ni yako kabisa.
The Champions League season is reaching a new peak. Are you ready for the ride?
Everything again.
Europe's finest football clubs are about to experience unrivaled acceleration. And DSTV gives you the best seat in the house. It's the thrilling rush to the UEFA Champions League final. Get connected to DSTV to experience every heart-stopping moment.
For a better tomorrow, don't forget to do the 1, 2, 3 with Colgate every night.
Ndovu flowers are fortified with vitamins and minerals to provide wholesome goodness for the whole family. Ndovu all-purpose flour makes the most delicious chapatis, mandazis and all other pastries. Ndovu is readily available at your nearest shop. Ndovu Tosha.
Ati, naweza taka kwa hii kabambe, nipate 4G smartphone.
Wewe wacha. Yaani mnasema badala ya kujikaza, ninaweza pata smartphone mpya na 20 bob peke yake daily.
Ati, badala hii tochi yangu naweza nunua hiyo 4G smartphone niangaliange vitabu kwa mtandao na ni 20 bob pekee daily. Pata smartphone mpya kuanzia 20 bob daily pekee ukilipa mdogo mdogo. Weka down payment ya 1000. Lipa kuanzia 20 bob daily kwa miezi 9. Piga star 544 hash kuona kama unafaulu kupata 4G Neon Ray Pro inayokuja na screen kubwa ya kutazama video, battery inayodumu, space mingi ya kuweka picha na videos, HD camera na apps zote za Google unazopenda.
Kuma bei ya smartphone hapa.
Si hapo sabari komuni yako kabisa.
Welcome back to Business Redefined. Tonight we are focusing on the Kenya Deposit Insurance Corporation and the mandate of ensuring that depositors' funds are safeguarded in Kenya's banking sector. And we have the Chief Executive Officer of the corporation, Mohamud Ahmed Mohamud. Welcome back on set.
Thank you, Julian.
There is the transition to a risk-based premium model. We have been on a flat rate for quite a while. And of course, it was to take effect in July 2020. I understand it has been pushed forward. Perhaps you could begin by explaining to us why this transition is critical and why the push forward to next year.
Thank you, Julian. Indeed, as part of our strategy as Kenya Deposit Insurance Corporation, is that for the last almost 35 years, our premium, and this premium is just like the insurance of your car, Julian. Every year you must renew the premium of your car, isn't it?
Yes.
So even the banks must renew their premium every year by paying us that premium. And that is what we invest. We build the fund I've been talking about to cover the exposure. Remember the exposure of the 600 billion? That is the premium which we invest to cover that in the unlikely event of that closure. And that's where we get our money. We least go to the government for any money, but we have a backup that in the unlikely event of us overriding our fund, Parliament can approve for us from the consolidated fund. But that is an area where we really don't want to go, but we just gave ourselves that backup. So it was felt that the flat rate was, we were charging all the banks at 0.15% of their annual average deposits. So it was felt now, being a resolution authority and being a risk minimizer, since we are talking of risk, we should also now extrapolate this risk now into the premium. We should not only talk of other risk while we are charging the same rate. So this risk-based premium, it's a model which has been applied in so many other countries. And indeed, that is what we want to really domesticate here. And it is one, it is equity. And two, it does what we call, it enhances what we call market discipline. Because a bank knows that the higher the risk, the higher the premium. Because most of the banks have shareholders. The shareholders will be asking, why are we being charged higher than another bank? You see, that will be a red flag on the management of that bank. So the management of that bank now will really make sure that they really manage the risks of the bank. The loans which now they give out, these loans, Julian, are actually financed by deposits.
Yeah.
And that's why we are talking deposit actually is the goose that lays the golden egg of the banks. And that's why you can see the deposit insurance, our primary focus is on that deposit because we know what it does and it can also be misused. So as part of our risk management initiative, because it is actually part of our mandate, because our mandate, our mission is to provide deposit insurance, incentives for risk management, and resolution of failed institutions. Yeah. So as part of our second mandate of risk management, we actually have a department called Risk and Examination, Compliance. We want now to bring the risk-based premium so that the banks now can be profiled on their risk basis. And most of the people ask me the question, what model will you use? Indeed, yes. Indeed, when the World Bank financed for us the study, the consultant came with a very complicated model. And we in KDIC thought that no, we already have a model. The central bank, which is the supervisory authority, does inspection of banks and come up with the ratings of those banks. So we shall use what we call the camel rating of the central bank in order to profile a bank, which is accepted by the bank and which has been formulated from the inspection that has been done by the central bank. So I told them we don't need to reinvent the wheel. We already have that X, we already have it. So we are going to use that the camel rating by the central bank, which now will rate now the banks according to their risk profile. And you see, this will also be an incentive for the banks to work on their risk management. Because if this year maybe your premium is higher, you'll have to work next year to make sure it goes down. Yeah. So you look at maybe in the profile, which are the areas I have a problem with. And you see that one also now speaks to reducing bank failures. Yes. So you can see how interconnected all these things are. Mm-hmm. And that is where KDIC comes in. Okay. And that's what I want Kenyans to understand. That is one of our roles. And working in conjunction with the central bank and the National Treasury and our membership who are the banks. So we came with the model, and the model was to kickstart on 1st of July, just like the coverage. However, with COVID, and when we looked at the COVID pandemic, when we were just trying to strategize on the impact of COVID pandemic, with my team, we thought it prudent that today, if you go and assess the risk environment of a bank, it will not give you the true picture, because there is another risk called COVID, yes, which has come in, which may not have been assessed, have not been identified, and have not been evaluated and mitigated. So we may wrongly or unjustly profile a bank. So why don't we give the banks another 1 year to sort out this pandemic, which actually to me is an external risk, which has just come into the bank, so that the banks within this 1 year can also now reconfigure their management frameworks and then come up. So by next year, 1st of July next year, God willingly, we shall go risk-based.
And holding on to that thought, just perhaps to get a little detail into the model of the risk profiling. One question that we have out here is that, of course, when banks lend to various sectors, the sectors have different risks. For example, if you look at the agriculture sector, because of some of the vulnerabilities the sector has, any bank that predominantly lends to that area will be deemed risky, or any bank that predominantly lends to SMEs will be deemed more risky. Don't you think there'll be the perverse outcome that because of this model, then banks will be cautious in terms of lending to these two areas?
And Julian, I don't think it will be that, they won't be that advanced, because the banks actually are experts in managing risks. And even financing some of these sectors, we are encouraging the banks to finance even the agricultural sector. But all these things, let me tell you, Julian, and you'll prove me right on this, is that most of this lending, the problem is maybe the monitoring part of it. They need to monitor and they need to follow. Because monitoring and evaluation is very, very important. Because one thing is, unfortunately, most of us is once you're given money, you can even divert that money. So we want to encourage, and I think banks now will also have to up their game and also to up their management style, because and even them, they must also manage this risk very, very well. Because if they don't manage the risk very well, there will be a failure. And a failure of a bank is actually, and this is what I always tell people, is that a failure of a bank affects lives and businesses and property, which is the cardinal principle of any state. That is why banks should really be very, very careful, even as a bank manager there, when you're giving out your money, you should make sure that the money goes to where it is worth. And I'm sure the banks know where to take their monies. They've been in this business for very, very long. They know what percentage maybe to. So they will also now be managing their own risk even more better than they were doing before. And you see, this one now speaks to that you'll find lesser failures of banks. Because one of the failures of banks mostly is corporate governance. That is the cause of the failure. Actually, that is the biggest risk to most of the banks, is corporate governance. So once the corporate, now you know that now you have been put now into another level, you'll also be more careful. But that does not mean that you're also going just to sit, because if we say risk, even when we leave our houses, we'll be exposed to risk. But you don't say, today I'm not leaving my bedroom because there's risk outside there. You have to go face that risk, know how to identify the risk, mitigate that risk, evaluate and monitor the risk. Because the risks are actually, what is business? Business is risk.
For sure.
Thank you.
And as we wrap up our conversation, and really to the point that you've just mentioned, many are curious, and I particularly am curious to understand, how does this risk-based model now take into consideration qualitative factors like corporate governance? Because we can easily look at the quantitative metrics, whether it's NPLs, etc., or liquidity ratios, for instance. But when you talk about now the corporate governance, how does it play into that whole matrix?
And Julian, if you look at this, the supervisory parameters, which is called CAMEL, the M is management. So that's where the qualitative aspect comes in. Because you must know management. How is the management? What are the caliber of people in management? What kind of people do they have management? And procedures, are they in place? Is there what we call segregation of duties? You see, all those things now speak to the qualitative aspect. Okay? That is why the M is there. And that is where now that is also another rating that they're being given. Okay? So I'm not worried about the qualitative aspect, because the qualitative is also intertwined with the quantitative, because it also speaks to the quantitative. And
perhaps just really, just to defray any concerns that we normally have around, do you think mid and small tier banks will be disadvantaged in one area or another in light of this?
And to me, I'm looking at it more positively for the mid and the small banks. Indeed, it will now give them an opportunity also to work on their risk framework. Because maybe before it was, because they say too big to fail and too small to matter. We are telling them you also matter in this scenario. So I think even for them, it will be, because theirs, of course, you'll find maybe their risk elements might even be lower than maybe the bigger banks because of size. So I believe they will also take advantage of this to actually make sure that they pay less on the premium than maybe the bigger banks. So actually it's an opportunity. They might look at it as a threat, but to me they should look at it as an opportunity, okay, to reconfigure their risk framework, to really invest in the risk management and parameters.
And my final question, what's your outlook, especially from a bank resilience and financial sector soundness perspective, especially in light of COVID going forward?
And COVID, Julian, to me, I look at COVID, as much as people look at it as a threat, we should also look at it as an opportunity. COVID will be there with us. We have to learn to live with it. We have to learn to manage it, just like any other flu. Okay? I know that our government has invested heavily in management of the COVID pandemic. Then actually I've come up with what I call how to win the W, the 3 W's of how to win COVID. Make sure you wear a mask, first W, wash your hands, second W, and watch your distance, third W. With those 3, we shall win COVID, and we can continue doing our business.
All right.
Yeah.
And that takes us to the close of our conversation tonight, where we have been speaking to the Managing Director and Chief Executive Officer of the KDIC, that is Ahmed Mohamud. And we've been focusing on 2 key issues, that is the transition to a risk-based premium model for banking insurance, as well as the bump up of the coverage to 500,000 shillings from the initial 100,000 shillings. Up next is the Markets Report.
Markets Review, proudly brought to you by Business Daily. More possibilities.
Now let's take a look at how the capital markets closed the day. The NSE 20 share index closed at 1733.14. That is changed year to date, down 41.46%. Of course, significantly, it breached the 1800 mark last week, and then change day on day is down by 1.61%. We're crossing over to the foreign exchange market. The shilling closed at 108.12 to the USD, and that's down 0.09 compared to yesterday. Against the sterling pound, it closed at 141.25, having gained marginally by 0.05%. And against the euro, closed at 127.24, up marginally again by 0.31%. And that's, of course, how the markets, both capital and forex, closed the day.
Markets Review, proudly brought to you by Business Daily. More possibilities.
And now that takes us to the close of business. We have been focusing tonight on the Kenya Deposit Insurance Corporation and the safeguarding of bank depositors' funds. Of course, you can be part of this conversation by tweeting at NTV Kenya at AmbokoJH. The hashtag is BusinessRedefined, and we'll be sampling your views, of course, and to see how to build on this conversation going forward and how to create awareness on this particular subject, given the kind of history that Kenya has had in the recent past regarding the stability and resilience of the banking sector. Let's do this again on Tuesday next week, same place, same time. Don't touch the dial. Stay tuned to NTV.